Ladies and gentlemen, warm welcome. My name is Urban Müller, and I'm responsible for client relations at BWM. The topic of our talk today is value investing, stars and scars from 25 years of practice. Actually, it's 26 years. We've been set up in 1997, and I'll talk about our firm briefly. Here you see the agenda. I'll give some backdrop to why we still pursue value investing, even though it's had quite a tough time of late. And then I hand over to George, who will cover really the experience piece, providing examples of value investing that hopefully might also be of value to you as investors in this room. And then at the end, we'll have time for questions. If you want to interrupt us, that's also totally fine. You can ask questions throughout our talk. So there are 6 of us, 4, including George on the top left, who co-founded the firm in 1997 and is a portfolio manager. 4 of the team are involved in portfolio management and financial analysis, so analyzing firms and assessing their worth. And then there's 2 of us, Daniel, who's downstairs at our booth, who look after the rest of the business. He covers operations, and I look after our clients. I mentioned the date of our setting up. It's 26 years ago. We are entirely focused on value investing and do that by offering for our clients and for ourselves 2 funds. The first of which is the classic global equity fund, and then a second one which we set up in 2004, which is a little bit more liquid. It invests in companies that have a market cap of 1 billion or more, so it's a little bit 2 billion and more, and it's a little bit, it's daily priced as opposed to the other fund. But effectively, both of these strategies, we are using the same investment approach, have very similar portfolios. There's a fair bit of overlap. And for us, it's very important that they both also have the same objective, which is to generate wealth over the long term, which we think we have been able to achieve. Now, in order to pursue that objective, we think that alignment with our clients really matters. We're fully independent, we're private, we are a partnership, and that allows us to just focus on managing the 2 portfolios, the 2 funds, for our clients. Now, why do we persist with value investing even though it's had a pretty torrid time of late? Well, on one hand, the data still, from our perspective, very much supports this investment style. We like to use data from Fama and French, 2 American academics who have assembled data going back 70 years, in this particular case, covering the US stock market, and they subdivide this data set into 6 different portfolios. On one hand, they subdivide the universe into small and large companies, and on the other hand, into cheap, expensive, and then another group in between. Out of these 6 potential universes and portfolios, I will show 3 here, plus at first the market. So you can see the market return going back to 1951 of $100, you made $200,000 over that period. So a very decent return. That's actually over that time period to 2024, almost the same as what you would have made investing in large cap growth companies. So large, expensive companies, expensive here is on the measure of price to cash flow by these 2 academics. Now, if you actually, for the period, had invested in value stocks, in large value stocks, you would have made $900,000, so a bit more than 4 times your money in the market. So value investing in large companies, for this particular sample, in this universe, paid off. But the jackpot was really small value companies. Now, we had a talk last year that as you zoom in on the right-hand side for the last 15 years, you notice that growth companies caught up tremendously, and actually, you don't see that very well. value, small in particular, over the last 10 to 15 years has really struggled. But that was the talk of last year, and the long-term track record is very much in favor of value investing. That's one reason why we persist and why we believe in this particular investment approach. The other one is that behavioral finance theory, which looks at how humans actually interact in the market, is supportive of the value investment style. You might be familiar with the analogy of Benjamin Graham of the market on one hand in the short term being a voting machine, and in the long term being a weighing machine. What he really means is that in the short run, the market is irrational. It votes depending on the behavior and feelings of humans mostly. Sometimes that's encoded in algorithms. And as such, what you find is that the actual prices of companies in the stock market fluctuate enormously around their actual intrinsic value. If you look at fundamentals of companies over time, they're fairly stable. The stock market, though, prices those fundamentals very differently from day to day. In the long run, though, the market really is a weighing machine. It gets the value of companies effectively right. And so that opens up a lot of opportunities for the patient and persistent investor. It does take patience, it does take experience in our mind, and that's why we apply process to really stick with key principles. And those principles, that's what George will cover in the rest of the talk. Thank you.
Thanks, Roman. So I'd like to go through a few examples of how to make your slides. No? All right, here we go. Okay, so I'd like to share with you a couple of examples of things that went well and things that went poorly, and draw a few lessons from those that may be of interest to you, and hopefully convince you that we know what we're doing. So the key for us is intrinsic value. We're trying to buy shares where we can value the company, and that's the price. The intrinsic value is the price that, let's say all of us in this room put our money together and we were rich enough to buy any company we want. You know, what would it be worth to us if we wanted to hold it forever over time? What would that company be worth? So that's the intrinsic value. It's the same thing that investment bankers do when they calculate takeover values and things like that. And then we're trying to buy at a discount to that intrinsic value, at a large discount. So intrinsic value is a function of two things. Number one is normal valuation. So what's it normally worth? I mean, the stock market usually gets intrinsic values, right? So what are the normal multiples for an asset like the one you're looking at? And then, of course, it's a normal multiple of the normal earnings that you want. You want to know what sort of cash flows the company generates over time. If it's a cyclical company, obviously you're not interested in earnings at the bottom of the cycle nor at the top of the cycle. Or if it's a company with problems, you want to know what should it earn if things are going as well as they are in the rest of the industry. So normal earnings is another way of saying earnings power or cash flow generation or whatever you want. At the end of the day, those are various definitions of essentially the same thing. And they, in turn, are a function of growth and margins. Earnings is revenue times the margin, and then you want to know how much the revenue grows, how much the margin is under normal circumstances. It really is that simple. So as an analyst, you spend most of your time trying to work out those two things. How much will this company grow? What kind of margins can it earn on that? And then you have an idea of its value. To do that work, we look at company history. We want to see how it's done over time, how comparable companies have done over time, and that gives us an idea of what's possible in the business in the future. And then we're trying to buy things trading at a 40% discount to the intrinsic value. It's not a hard and fast rule. We'll make exceptions if something is particularly safe. If it's particularly predictable, we'll pay for less of a discount. But if it's especially risky, we want a bigger discount. Okay, so where does this go wrong? Well, number one, it goes wrong if a company has financial leverage. You can be the best analyst in the world, but you'll probably but you'll have a hard time if the company has a lot of financial leverage. Let's take the example of AA PLC. This is a mistake we made because we thought we were really smart. AA is like TCS, it's roadside assistance in the UK. So cars always break down, people need help with batteries that go down. It's an extremely stable business. It's a high margin business. You don't negotiate with AA when your car's broken down, right? You've already paid up front anyway. So the cash flows are extremely stable in this business. And the company had come to the market out of a private equity IPO'd it. The trouble is, when we bought it, it was too soon after private equity had IPO'd it, and management came out and said, listen, we've been underspending on marketing and on systems. That's our mistake. We should have seen that, but we didn't see it. I don't know if we could have seen it, but if one could see it, we should have seen it, and we didn't. So that meant that they would earn less EBITDA in the future. That meant that the interest coverage was lower. This was a highly leveraged company because of the stability of its cash flows. It had been loaded with debt. It was trading at it had 8 times net debt EBITDA, which is very high. Refining costs went up. A hedge fund came in, took it out, and basically it was the only offer on the table. We had to accept it, and we took a big loss. So the key here is it's the debt. It's not the operations that killed the stock. If a company has low debt, it can always wait out. It can solve its operating problems if it has them, and then at some point it'll be fine again. But if it has a lot of debt, it gets killed. Here's some slides to show that. On the left, you see EBITDA. This is EBITDA that as the company was earning it in fiscal year 19, that would be a March fiscal year. Then they said, we have to spend more money, so the EBITDA estimates came down, and the actual EBITDA came down. But the idea was, of course, we're investing in the future, blah, 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 and so that the EBITDA would rise again. And our estimates are in the green bars. The blue bars are what actually ended up being reported. And as you can see, our estimates are too high, but they're basically right. Directionally, EBITDA does recover, and this is not a huge swing. I mean, from 380 to 300 isn't great, but to go back to 350, that's pretty good, and it's stable. But because of the debt problems, when they announce these, when they announce that they have to spend more money, refinancing costs go up, they become prohibitive, and at that point they're caught. There's really no way for them to get out of the trap of having to pay high interest rates to refinance the debt as they roll it. So one of the lessons that we've taken from that is be very careful with debt. Be even more careful. Don't make exceptions. Now, if you're better at estimating, let's go to something positive. If you're better at estimating earnings growth than your competition, then that's probably going to be a good stock for you if you're buying it cheaply, because the expectation in the market is that earnings growth is going to be low. And you think, no, it's going to be higher. The market will be surprised, and then the stock goes up. That's one reason value investing works. When you have a surprise, more often than not, it's positive rather than negative. So my example here is H&R Block. It's an American tax preparer. If you've ever filled out an American tax return, you'll know why you want a professional to do it. It's nothing like here in Switzerland. It's very complex. So even people who don't have complex financial situations will go to H&R Block, have them fill out the tax return for $150 and get the refund up front. Now, H&R Block had been losing share to online and do-it-yourself solutions such as Quicken and QuickBooks. They hadn't reacted well to that. Their prices had been too high. They got new management, and new management said, listen, we have to stem the loss of market share. We're going to lower our prices and reorganize ourselves a bit. And we thought, okay, pretty good. Sounds good, sounds like a convincing plan, but they're still going to shrink. And when we initially priced the stock, we figured that it was probably going to shrink at 2% a year, while the market was expecting 5 to 6%. Now let me explain the chart on the left. In gold here, you see the share price, and the solid bar is always the intrinsic value. And sometimes you'll also see a light blue bar above and below. That's an estimate of the high and the low intrinsic value. We tried to estimate all three values to give us an idea of the contingency of earnings results, just to understand the risks better. So you see, and then the red bars show you when we bought and sold. So we buy a big position when the stock's trading at a large discount to intrinsic value, then it goes up nicely, but at the same time, we get to revise our estimate of the intrinsic value up because it turns out we're too conservative. The company actually grows faster than minus 2%. I mean, it doesn't shrink anymore, it actually starts growing. Ultimately, they actually grow at 3 to 6%, which was their target, and of course that leads to a PE expansion, and the stock was a big winner. So in that sense, if you do your analysis and you have the right judgment of the people making certain promises about the future, you can do very well. So this would be one of the stars. But of course, there are scars, like Credit Suisse, where you get that wrong, where you believe the management, and then they turn out not to deliver. We thought Mr. Dijon would do a good job. He did not do a good job. He had done a wonderful job at Prudential, but when he came to Switzerland, it didn't work at all. All of us knew that the private and the investment banks were undervalued, that they were undermanaged, that they were not earning enough. He was going to do better on both scores, and he did not. In fact, we had all those scandals as a result. So that's where you get killed as a value investor. You think the asset is cheap, you think someone's going to run the asset better, and then they don't. And if you're really unlucky, they run it worse, which is what happened here. Or unlucky, if you really take the measure of the man poorly. So what this is a classic value trap. It's a difficult asset, not very well managed, and we took a bet that we should not have, that someone was going to manage this asset better. Let's take another asset that's undermanaged. It's Kelly Services. It's an American temporary employment agency. It's like Adecco, except they were one of the very first companies in the business. They were run by the fellow Mr. Kelly first, and then his son-in-law, who were not interested in maximizing profits. And for the longest time, the management did not manage the business well. And we recognized that a long time ago and got into it in 2009 already, always in the expectation that the management would start to run the business better. And we wrote to them a number of times, and they said, yeah, we're working on it, blah, 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 blah. We finally wrote to them a fourth time in 2022, early 22, apologies. And we showed them, we included in our letter the chart on the right. It shows the so-called conversion rate or conversion margin. It's the EBIT divided by gross profit in the temporary employment business. And as you can see, Kelly is by far the worst of any of these companies. And that's embarrassing if you're on the board of directors. It's embarrassing if you're the management, but then you always have an excuse. But if you're on the board, it's not a nice thing to read because you have a fiduciary duty. You're always going to get worried that someone's going to sue you. And they actually then, at that point, the family was no longer interested in preserving as many jobs as possible and being a wonderful member of the community. They actually said, no, we have to run it better. And a big program of cost cuts began. And that cost cut program is now running its course. We're starting to see it in results. You see that the share price has been going up against the industry. This is since 2022, you have not really wanted to own Randstad or some of the other temporary employment companies. But Kelly, because it's managing the business better and is starting to raise its margins, is actually had nice performance. So here the lesson is, if you're patient and you're engaged and you talk to the company and they take you seriously, sometimes they'll listen and sometimes they'll do the right thing. And in the meantime, waiting was not a problem. This company has a super clean balance sheet. It has net cash most of the time. And I mean, it wasn't making us any money for a while, but it was okay. And I think in the end, it will make us a lot of money once they get somewhere closer to industry average margins. Now, value investors, we also invest in asset plays. That's one of the things we do. We talk about asset plays. But an asset play is really just another way of saying we're looking for things that are going to earn money for somebody sometime. And not just because they sell it. If you think of the value of an asset is only as much as the cash that you can earn with it over time. So even a piece of land is only of interest financially because someday somebody will make money with it. Let's say it's just it's not being used. So you always have to think of assets in terms of their ability to generate cash in the right hands. And one of the areas where we like to look is when companies have more than one segment, maybe in different businesses, so you'd say a conglomerate or something like it. Where the different segments, the different assets may not be performing as well as they should be, maybe because it's in a conglomerate structure and the management at the top isn't managing the various segments well, not as well as if the company was independent. The segment was independent. And because the segments, even if they're well managed, differ in terms of their economic characteristics, so their growth, their earnings, their risks, they deserve different multiples. And the market often does not do a wonderful job of pricing each segment correctly and then pricing the entire company correctly. And so we like to look for companies where there's a business that may not be managed as well as it should be, or that has a good future. And I'll give you an example here. It's a French company called Quadient. Now, Quadient, if you, on the left, you'll see which segments it's in. And we'll start with the top one. It's franking machines. Franking machines, you know, for letters, putting the postage on them. Not a growing business. But it's a highly cash generative business because you buy the machine or you rent it, and then each year you pay for the usage of it essentially. But it's shrinking 3% a year, so we put a multiple of 5 times earnings on that. That's still worth 18 euros per share. It's not nothing. The share price is about there. Then they have software for client communications. That's when you get a letter from your insurance company, or you get an email from your insurance company, or both. The company needs to know who's being sent what. That's what this software does. It's actually a Swiss business. That business is high growth. There's a number of companies competing in that space. They are valued at 3 to 7 times sales. We put a value of 2 times sales on it just to be on the safe side, and we get a value of 15 euros per share. Then they also have a third business, which is a growth business and is not so exciting. It's parcel lockers. You know, those boxes where if you receive a parcel but you're not home to get it, you enter a code and then you can retrieve your parcel. And the people who deliver it put the stuff in the lockers. It's a growth business, but we're not so sure it'll be a success. But it's worth 4 euros, and then there's some other stuff, net debt and a leasing book. We get a total value of 35 euros. And the reason that the stock is trading at roughly half that is because people do not realize how incredibly interesting and how good the client communication software business is. So we've got an intrinsic value on that's somewhere in the mid-30s with a high and a low multiple that are quite wide around that. Mostly the high is if someone were to buy the software business at one of the sales multiples that we saw, 3 to 7 times, then of course the stock is worth a lot more than the price that we had put on it. So what the market has done is not getting right, it's not getting right the growth and the margin potential of the businesses. It just sees the franking machines, I think. And it focused just on the reported results. And of course, the reported results right now are such that the earnings from franking machines are coming down, and the high-growth software business is getting better, but it's not hugely profitable yet. But it will be, and the value will come out over time, and then people will say, oh, this is a growth company, in spite of everything. I didn't know that. And that's when the multiple will expand, and I think we're in that point now where the earnings are starting to grow. So the key is the sum of the parts analysis, which reveals the value of the individual assets. And then, again, patience is required until that value comes out. Here, we don't need to badger the management to do things better. They're already doing it fairly well. And that's the investment case. And then sometimes, of course, we can do a little bit of, in a sense, it's an arbitrage of time horizons. You can buy companies that are doing well, that are well-positioned, that just basically have nasty circumstances that are depressing earnings, and the market's in a panic, and everyone's focused on the next few months, and you can pick those up cheaply. And a perfect example of that is Compass, something that we bought during the COVID crisis. And why were they doing poorly? Well, in the food service business, they run canteens. I don't know, maybe they run the canteen downstairs. No, that's not that, that's someone else. But that's the kind of business they're in. And obviously, when you have a pandemic, that business is dead, or largely dead. And that's what happened to Compass. We knew that their earnings were going to be terrible in 2020. And then after that, nobody really knew what would happen for a while. Well, but they kind of knew, but investors didn't care. And that's kind of the interesting part. Let me show you this. So imagine we're in April 2020. Remember back, we really didn't know what was going to happen. Would we go back to the office? Would we not? And the consensus earnings for EPS at the time was 115, but coming from like 130 pence per share. But it was coming down quickly. If you look in your Bloomberg or your whatever your terminal that you use, the consensus is always just the average. So as analysts come out with lower earnings, that consensus will come down. But for as long as old earnings estimates are in there, they're going to skew the consensus. So anybody who was dependent on the consensus numbers as reported saw that the stock was probably cheap. If 115p was something near normal, it was probably cheap, but nobody knew where it was going. You were unsure. And the market at that point was pricing the stock as if earnings would be 55 to 60p. That's how low it was falling because of the uncertainty. We did the work and estimated that EPS would probably be something around 100p or 97p. And this would be the estimate for fiscal year 2022. For the fiscal year 2022. So we're looking through the pandemic, right? This April 2020, and we're all asking ourselves, how's the stock going to perform in a year or two? And we thought, they'll probably come back. They'll make roughly £1 per share. And the consensus within about 3 months also said that we would be making roughly £1 per share. Only 3 months later, right? The blue bars are where we stand in April 2020, what the market's implying, what the consensus actually is, and our estimate. And the consensus ends up roughly near our estimate because what we do isn't that different from what everybody else does. You estimate sales and margins, like I said before. But because we were pretty sure that the company would be back to earning £1 per share by the time things normalized, we bought the stock while people who depended on the consensus numbers were still asking themselves, shoot, what's going to happen? So doing your own research helps you cut through the confusion, and that's certainly something that is essential to the way we work, and I recommend everybody do that. Do your own work, do your own thinking, do your own research when you're trying to estimate where a company is worth. So to summarize, the key questions when you're investing is always, at least from a value perspective, what's the business worth and why? And the why, of course, gets to the riskiness of it. Why is it worth what you think it is? Why might you be wrong? That's why we have the high and the low values. And then it's, how will that value be realized? Does the company post good earnings and then the rest of the other investors notice it too and buy it? Or do you push the management to change something, or does the management change of its own? And of course, there the problem is, do you trust them to do what they say? As we saw with Credit Suisse, that's not always the right bet. And so you also have to live with the fact that you're going to make the mistakes, that you'll be getting your scars as you invest. But over time, the value style, at least this style of looking for undervalued assets, ought to provide you a good return. To close, I just give you a flavor of where our portfolio stands, since after all, this is a marketing event. You see our classic global and classic value funds in the first two columns and the MSCI World on the right as a comparison. You see that that our shares, our portfolio on average is at half the price book multiple, half the PE multiple, whereas it has a higher dividend yield, which means the market is valuing the earnings, the ability to generate cash more cheaply than it ought to. We ourselves think that our shares are trading at something around 55 to 60% of intrinsic value on average, which means you actually are buying $1 worth of value for 60 rappen, or for 60 cents, or franken, 1 franc for 60 rappen, that you are getting a portfolio that's very cheap, and that over time, as we saw from Urban's slide with the FAMA French data, that ought to provide you with a decent return.
Question, sir.
Can we ask you for the microphone? Do you mind? This is being recorded. Thank you.
If you can go back to the previous slide, please. So how are you calculating your intrinsic value? Are you using DCF, option pricing model, or like just multiple pricing models?
Yeah, we use all of those.
For the intrinsic value?
Yes.
Okay.
The point is, if you're calculating the intrinsic value using one multiple and you get a different signal with another multiple, then you probably don't understand the company if you can't explain the difference.
Yeah. No, but those are multiples. Are you using actually discounted cash flow model?
Also, yes.
Also. So you must be getting different values than how you come to like one value.
Yes, that's the point. If you get a different values, then you want to understand where that comes from and which of your assumptions may be wrong.
Okay.
Plus,
In the end, you want to harmonize it.
yeah, and to add, as you saw in previous slides, we typically have both a kind of a mid-range intrinsic value and a high and a low to indicate that there isn't one specific number.
You're creating a distribution, basically.
Yes.
Yes.
Okay.
Think of it as a normal distribution around.
Yeah. Okay, great, great. Any kind of software you use, like Crystal Ball or something?
Software?
Yeah.
Excel.
Excel. Okay. Very good.
No, this isn't something that you can program into a computer. I mean, you don't need to. It's not that hard. Right? You're going to estimate the sales, you're going to estimate the earnings, you're going to multiply it by something, or if you're doing the DCF, discount it back. All of that's classic Excel stuff. Add it up, subtract the debt, divide by the number of shares.
Great. And for the risk, do you do like a bottom-up beta, or you just use like whatever Bloomberg beta is?
No, the data that we use is our data.
The beta, like, for
We don't use a beta.
For the risk?
We have a very concentrated portfolio. We're absolute return only oriented, and we do not look at tracking error.
Oh, okay.
So you will find a very high tracking error in our fund, as we're not focused on.
Very interesting.
And our discount rate, we do not use beta to estimate that. We think that equity investors, as a rule, want 10% on our money. So that's our normal discount rate. Certain companies are so low in risk that maybe 8 or 9% is more appropriate. But that you can usually tell by looking at the multiple what the right discount rate is. I think the beta itself is rather poor measure.
Yeah. So what are you using then to like put a number on the risk? Like, what framework are you using if you're not using beta to put in the value?
It's essentially how sure am I that there's not something. The question is, how certain am I that my earnings projections will actually turn out to be true?
So you're just measuring those probabilities, basically.
Yes, implicitly. We're not explicitly saying I've got, well, yeah, we actually do put a probability around it, but that's guesswork to some extent.
Thank you. Sorry for
No, that's fine. Those are all fair questions about how we work. But basically, you're trying to, that's the point of having high and low intrinsic value estimates is to say, okay, if things work out on my base case, or my base, it is what it is, and then how certain am I that that's going to happen? So you'll look at various variables that will move that, and you ask yourself, how likely is it that I will have a deviation according to that variable? So for example, right now, Adecco. Adecco has a certain level of earnings in one of its segments, but they promise that they're going to give us cost cuts. They promise us cost cuts in the Akkodis segment, and the market doesn't give them any credit for that. If you look at the consensus earnings estimates for Akkodis, there's not much cost savings in there. Some, but not a lot. Nothing like what the company is promising. So if you think that Denis Machuel, the CEO, is trustworthy, you say, okay, we'll give them more of that. And then you put a probability on it. How likely is that to happen? So how good are you at estimating that? And what nasty circumstances can come in. So if you say, for example, a 25% probability that it will get that they'll get the full cost savings, you're probably not completely wrong. Okay?
Yeah. Thank you.
You're welcome. Any more questions, please?
You might just want to show the next slide.
Did I skip one? Oh, right.
So the communication with our investors is very important. So we do quite a few events where we are able to exchange views, provide perspective on our portfolio. We have a Swiss Value Day, now the third time, coming up in just a couple of months, which we organize together with 3 other investment managers, to which you're cordially invited. We have a booth downstairs where we have details for the event. We organized last year an open house. We'll do that again. And then we have annual presentations. I should also say that in keeping with the theme of trying to buy the franc at 60 Rappen, we offer sausages downstairs for lunch, including vegetarian sausages at 60 cents to the dollar at a discounted price. You can get that discounted price by coming to our booth, and we have Bierdeckel. I don't know how to translate that. Beer mats, thank you. Which basically allow you to then get the sausage. We thank you very much for your interest. We are available for additional questions, and hope you have a nice rest of your FINANZ'24. Thank you.